controller account. Okay, so the task itself, as we can see here, is worth 10 marks, and that therefore means that we will have 11 minutes to complete it. And what we've got just below down here is an example of how one of these tasks will appear to us in the exam that we are going to work through together now. So what we are first of all given here is a summary of the transactions recorded in the VAT control account. So we've got all of our different amounts here, all just as one big list, and all that they want us to do is just enter as to whether each of these amounts would either be on the debit or the credit side of the VAT control account. So all that we're going to do here is just walk through piece by piece each one, so that we can complete and finish this off. So one at a time, all that we will start with, if we have first of all our VAT sales day book. Well, our sales day book, the VAT on our sales will be increasing the amount that we owe to HMRC. So this here, if we're increasing a liability in that case here, all that I will do is for my sales day book, which will come in just here, 85,000, just like so. Perfect. So my first one, absolutely done. My second one, naturally, sales returns day book. So if we're making sales, but the customers are then returning their items, well then we don't need to pass on as much VAT to HMRC. So what we should have down here is our sales returns day book, and this amount was for, as they said, 3,000. So great. So first two, absolutely fine. Now what we have then, and these are really important ones to make sure that we get right, is discounts received. Now remember, if we're receiving a discount, this is reducing the cost of the item that we are purchasing. And so therefore, if we're reducing our input VAT, we're not going to be reducing that liability as much as what we thought. So if we do ever have any discounts received, these will always be on the credit side. So just in here, so absolutely fine. Our discounts received will just come in here, and this was for £150. So great. So we have got those first few done. So we can tick off discounts received. Our next one is our VAT on purchases. Now remember, this is a purchase, whether it's on cash, whether it's on credit, it is still a purchase and is going to be part of our input VAT, which will always be recorded on our debit side as we're reducing that liability. So for our cash purchases, this will just come in here. So our 1,000 for this will come into here. So really, really good. And we must remember that, as I just said, this will be the same whether it's for a cash purchase, whether it's for a petty cash purchase, or even if it's the credit purchases on the purchase day book. So whichever that we have here for all of our different types of purchases, they will all come straight down here. So we can put petty cash, which was for 500. We can have as well our purchase day book as well for those purchases that are made on credit, which was for £25,000. And what that does mean, therefore, is that when we are going through all of these, that only leaves us with a few left. Our purchase returns, well, just like sales, if our sales Getting our VAT on sales would normally be a credit as we're increasing the liability, and our sales returns were a debit. Well, our purchases also must work in the same way, where if my purchases, that input VAT would be a debit, my purchase returns must therefore be a credit, which is for 1850. So great. If I've made a payment to HMRC, now what we must remember here, that for if we have got any payments made to HMRC, that will be reducing the liability because we don't owe them as much now as we're settling what we owe them. So this will be made in cash, this purchase to HMRC for 55,000. So to reduce that liability, we debit it. And all that leaves us with then as our very, very last little one is our VAT, still on sales, which is a credit, and here it's just cash sales, so still will be on the credit side. So really good. So for 5,000 here. And that's it. And that's all that we have been asked to do. So really, really good. The very final few little bits that they have also asked us to do here, is that Dilly has the following receivables ledger control account. So what we are told here is we are given the balance brought forward of 12,560, and that we have then made further sales of 123,450 to further increase the amount that is owed to us, as these are sales that are made on credit. But then customers have given back goods worth 12,560, and we've allowed customers to have a 3,450 of discounts, and we have received £112,356 coming into our bank. So all that they want us to do to finish this bit off here is work out what will be the balance carried down. So all that we have to do is finish off this T account. So what we will always do is add up to see which side is higher. So here we can clearly see that the higher out of the two sides is the debit side, as this comes to 136,010, and therefore so must our credit side. And what therefore must be, our balance carried down must therefore be the difference to make that credit side also equal to 136,010. So if we do 136,010 minus everything that we've currently got on our credit side, our balance carried down, therefore we must still be owed 7644. And that is absolutely it. So really, really good. And that will then come, just remember to enter this as well, just in here. So lovely stuff. And the very final little question that they have asked us then is that a payables ledger control account is shown in the general ledger. They have said identify which one of the following is correct in relation to the payables ledger control account. So first of all, they have said a payables ledger control shows the total amount owed to the business from credit customers. Not quite. It's the suppliers. So remember here that it's not customers, it's suppliers. So it's definitely not the first one. They have said for the second one, a payables ledger control enables the quick identification of an amount owed from a specific customer. It's not. The control is right in the previous statement that it shows the total, but it doesn't tell you how much a specific customer owes us. That's the memorandum, or the payables ledger, but not the control account. So no. Thirdly, a payable ledger control account should always be produced by the same person who produces those memorandums or subsidiary ledgers, as this improves accuracy. Not necessarily. Actually, ideally, it would be produced by two separate people to enable and to ensure that there are that segregation of duties. So for that final one, then hopefully this last sentence is true. A payables ledger control account shows the total amount owed to credit suppliers. Absolutely. So really, really good. And that's it for task 1. In task 2, here we are given a summary of transactions with customers during the month of October. And what they want us to do here is show whether each entry will be entered as a debit or a credit in the payables ledger control account. So we've got payables and it's the control account. Okay. So simply just say debit or credit. So remember that our payables is the money that we owe to our suppliers. So we've got to be thinking here, will it increase or decrease the liability? So if we have purchase invoices that we receive from credit suppliers, well, lovely. When we get invoiced, that's going to increase the money that we owe our suppliers. So to increase a liability, we credit. If it's a journal though, debit to correct an error, well here, lovely, they've said that it's a debit, so absolutely fine. The third one though, credit notes received from credit suppliers. Now, if we receive a credit note from our suppliers, that's reducing the liability and the money that we owe them. So that if we want to reduce a liability, we debit it. If we receive a discount as well, that also reduces the money that we owe our suppliers, and therefore that too will be a debit. As will finally, if we make a payment to the suppliers, so payments made to credit suppliers is reducing that liability, and therefore, like the others, would be a debit. And if we have a balance owing to our suppliers at the 1st of October, this will be an opening balance and therefore would be on the credit side as well. So really, really good as a nice little star here. So fantastic. Now, all that they have then said is that using these numbers, what will be the balance brought down on the 1st of November? So what you can always therefore do here is think, well, we know that our balance, as we were just very much saying here, we will have our 74, and if you imagine this here, 398, that will be adding to our liability, so we can add that, and we can then as well also add the amount that we have down here of the 183,295, because that's the amount owing at the start of the period. As well, so we had that brought forward. We've then received further invoices for 74,938, and then we deduct everything that reduces that liability from this of 320, 5439, 3299 and 65693, and what that would then give us would be, if we did all of those, a final figure of 182,942. And we must remember here that as this is still a liability, it would be showing therefore on the credit side. So we would go to 182,942, and as we can see it's a credit, so we would take this one here. So really, really good. Excellent. Now, what we are also told down here is that the following balances were listed in the receivables ledger at the beginning of December. So what we can see here first of all is that we have got all of the individual amounts okay, as it's the receivables ledger from each company and what they owe us. All that they want us to do here is they have said what should be the balance on the receivables ledger control in order for it to be reconciled with the total balances in the receivables ledger. In other words, what they want us to work out is what is essentially the receivables balance. And the key thing that we must all recognise here is that whilst all of these here will be adding to the amounts that are owed to us from our customers on credit, just remember that we have got, and they've snuck it in here down the end, one customer who's in credit with us. So actually we owe them money. So we will deduct that away from our receivables. And if we do all of that, okay, this will bring us out to a balance of 68,877 as the total amount due to us. And as this is still net a debit, we will go debit balance at the 1st of December for 68,877. So really, really good. The very last little part that they have asked for down here is they have said is that if the receivables control account is greater than the total balances on the receivables ledger, what could explain the reason for this? And there's two here that we have to tick. So first one, they have said discounts allowed may have been omitted from the control. Well, yeah, because that would explain why then the control is showing that we are owed more, because it's not incorporating the fact that discounts should have been included. So that's absolutely fine. Okay, no problem there. They've then said discounts received may have been omitted from the receivables ledger control. Well, discounts received is what goes into our payables, so it can't be this one. So it can't be the second one down. The third one though, sales invoices may have been entered into the receivable ledger control account twice. Well, yeah, absolutely, because then it's going to look like the same customers owe us twice the amount of money, and that would explain why the control account is greater than the receivables ledger. So yeah, and it can't therefore be then lastly that the goods returned have been entered twice, because that would therefore mean that the receivables control account we would then expect to be less than the receivables ledger, which here they've said it is not. So really, really good. And that is it. Fantastic. In task 3, we are asked first of all to show the most appropriate method of payment for transactions shown below. So what we have got here, we have got the following list of payment options. So we've got our BACS, our CHAPS, check, credit card, debit card, direct debit, or standing order. So all that we've got to do is say which one of these is most appropriate for each of the types of transactions below. So for the first one, they have said here a payment for rent each month that does not vary. So if it's ever something that does not vary each month, well, what would be the most suitable method of payment would therefore be a standing order. Okay, because this is when you are paying a regular amount for a set period of time, so once a month, etc., every quarter. But the key thing is that amount does not vary. So standing order could be great here. Another we have got is a payment made by a supplier by which immediately impacts on the bank account. Okay, so the key thing here is as it immediately impacts on the bank account. Okay, that will therefore be not our credit card, but our debit card. Okay, so yeah, because that will mean the money is taken instantly from our account. We also have then a signed written order to a bank to transfer a payment of a set amount to a supplier. Okay, so as soon as you see the words a signed written order, we know here that it must always be a check. because you have to sign these. And lastly, a regular payment each month for utilities where the amount varies. So maybe dependent on the amount of electric, water or utilities that you actually use, the size of the bill will vary. And for this, therefore, we will go for a direct debit. Because this, unlike a standing order, which is every month maybe we pay the same amount, a direct debit is that every month the amount may vary, dependent on use. So good. In part B, they have said identify whether each of the following statements are true or false. So first of all, they have said a direct debit for insurance of £120 is shown in the bank statement. This has not been reflected in the cash book, and 120 will therefore need to be deducted in the bank reconciliation to make it agree. This is false. The cash book would need to be updated here in order for this to then be correct. So not the bank reconciliation. The cash book would need to be updated. So they have then said unpresented checks and uncredited lodgements are examples of timing differences. Absolutely right. So this is when we have either paid money out, for instance, and are still waiting for those amounts, to clear. And finally, the bank took a payment of £450 from the bank account. This was an error as this related to a different client. Therefore, £450 should be deducted from the cash book. Not at all, because the amount has left the company. The expense here does not relate to us. We would need to inform the bank and for them to then make the rectification. So really good. And the final little part with part C, all that they have said is show which one of the following statements is true. So out of these here, straight away one that is not is that all errors are identified by completing a bank rec. That is not true, because this will only pick up errors in the cash book and the cash statement when rectifying and reconciling these. And also as well, the other one that is false is that the bank statement is always up to date, and therefore the cash book should be changed to reflect the bank statement. And this is what we were saying before, there will be sometimes timing differences where actually the cash book may be more up to date, so it can't be this one. But the one that is absolutely true is the top one, that the cash book is likely to be more accurate than the bank statement due to those timing differences, like what we just said. And that's it for task 3. So really, really good. In task 4, we are given here on the 26th of July, Pennington Limited, who received the following bank statement as at the 24th of July. So what we have got here from their bank, Middle Bank for Pennington, is their balance brought forward, a whole host then of checks being paid out, some counter credits being paid in, some backs transfers, and then a final few standing orders, direct debits, and also then some bank charges and interest as well. To come down to the final, as you can see here, debit balance, as that's why we got the D next to it, of 3387. So what they want us to do here, with our cash book just below for Pennington, also at the 24th of July, with again all of the money coming in and going out, as well. All that they want us to do is update the cash book, and prepare a bank reconciliation at the 24th of July. And they said select your adjustments from the following list. So we have got our little reconciliation here and our cash book just above for us to be updating. And by doing that, then everything should fit in quite nicely. Okay, so where we are going to begin with this here, okay, what we can straight away see is that they have given us, for our cash book below, the closing balance. Now, they did say it was a debit on the balance on the bank statement, but that's from the bank's perspective. So that really means that we have a credit balance of 1397, and that is what you would get by totaling up everything here, from our cash book. Now, what we need to do is figure out, well, what is missing in this cash book here, but that is showing on the bank statement. So, as you can see, and if we start with the money coming in, we can see that we have got Bryce, Moore, Payton and Habgood, who are all coming in to the cash book. And what we should therefore be able to do by matching off those amounts is tick them off. So for Bryce, the 2498, we can see therefore that that is coming in, as you can see under the paid in column, of 2498. Lovely. So that first one is on there. So great. What we can then see is that Moore has a payment of 984. That is included on the cash book, as we can see here. But actually then, when we look up, that 984, oh yeah, that is just down here as well. So absolutely fine. So fine, those first two are here. But then we have Payton of 2092 and Habgood of 2863. And that's the thing here, we can't see these monies coming in at any point on here whatsoever. So what we will need to do, as